Financial reporting and analysis, inventories. Example 1. Acme Enterprises, a hypothetical company that prepares its financial statements in accordance with IFRS, manufactures tables. In 2018, the factory produced 900,000 finished tables and scrapped 1,000 tables. For the finished tables, raw material costs were 9 million. So for finished tables, raw material was 9 million. Direct labor conversion costs were 18 million and production overhead costs were 1.8 million. The 1,000 scrap tables had a total production cost of 30,000. So we have scrap tables as well. So it has a $30,000 cost, production cost, and 220,000 conversion cost, which inclusive of 10,000 raw material cost and 20,000 conversion cost. These costs are not included in the 9 million raw material and 19.8 total conversion cost of the finished tables. During the year, Acme spent 1 million on freight delivery charges on raw material and 500,000 for storing finished goods inventory. Acme does not have any work in progress inventory at the end of year. So what cost should be included in inventory? So as far as your inventory is concerned, we are dealing with finished tables. So the raw material is 9 million, direct labor conversion costs were 18 million, and production overhead costs were 1.8 million. So production overhead cost was 1.8 million. So, and again, we also need to add 1 million of freight delivery. So delivery charges needs to be included, 1 million. So if we add all of them up, 9 million plus 18 million plus production overhead plus 1 million transportation cost. So we have total inventory of 29,800. Now the second part is what cost should be expensed. So now 30,000 is coming from your scrapped tables and 500,000 for storing. Now, despite the fact that this is storing finished goods, that this is the cost associated with storing finished goods and inventory, but this again 500,000 hasn't been used in the manufacturing of those tables, so we won't include this as part of our inventory. So the expense in 2018 would be abnormal waste, that is your scrapped tables, 30,000, and storage of finished goods inventory, that is 500,000. So your total cost would be $530,000. Example 2. Global Sales in Company is a hypothetical Dubai-based distributor of consumer products including bars of luxury soap. The soap is sold by kilogram. GSI began operations in 2018, during which it purchased and received initially 100,000 kilogram of soap at 110 dirham. So this is the price or the cost. Then 200,000 of soap with the cost of 100 dirham or AED. AED is a better representation. Third, they purchased 300,000 kilogram for 90 dirham. GSI sold 520,000 kilogram of soap. So they sold 520,000 at 240 dirham. GSI stores its soaps in its warehouse so that soap from each shipment received is readily identifiable. During 2018, the entire 100,000 kilogram for the first shipment received, 180,000 kilogram of the second shipment received, and 240,000 kilogram of the final shipment received was sent out customers. So out of this 100,000, the whole 100,000 went out of this 200,000, 180,000 was shipped to the customers, and out of this 300,000, 240,000 was shipped to the customers. Now, what are the reported cost of sales, gross profit, and ending inventory balance for 2018 under the specific identification method? So total sales quite simple, would be 520,000, because this is the amount that we sold, multiplied by 240. This would account for 124 million 800,000 dirham. Now your cost of goods sold, your first batch, this is sold to the customer, so 100,000 multiplied by 110 plus 180,000 was sold from this second batch, so 180,000 multiplied by 100, and the last 240,000 was sold from the third batch, multiplied by 90. So if we add all of them up, so this is what it is. This would be 50.6 million or dirham. Now your gross profit would be 124.8 million minus 50.6 million, that is equal to 74.2 million, and your ending inventory would be, out of this 100,000, total of 100,000 has been sold, so nothing of that is left. Out of this, 20,000 is left from the second batch. 20,000 is left, multiply by 100. From the third batch, 60,000 is left. So 20,000 multiplied by 100, 60,000 multiplied by 100. So in the end, the ending inventory would be 7.4 million dirham. Now note that in spite of the segregation of inventory within the warehouse, it would be inappropriate to use specific identification for this inventory of interchangeable items. Usually specific identification is used for an item that are not interchangeable. For example, properties, highly expensive jewelry. The use of specific identification could potentially result in earnings manipulation through the shipment decision. Now the same question, but now we need to report cost of sales, gross profit, and ending inventory balance for 2018 under the weighted average cost. Now again, sales would remain the same. We sold total of 520,000 multiplied by 240. Our total sales remain same, that is 124.8 million. Now our cost of goods sold would be, now this is weighted average cost that we need to use. So first of all, we need to find out the weighted average. So the total cost, we need to find out the total cost. So total cost would be 100,000 multiplied by 110 multiplied by 200,000 multiplied by 100 plus 300,000 multiplied by 90. So the total cost, would be 58 million. Now 58 million needs to be divided by, so we had how much? 100 kilogram in our first batch, 200 kilogram in our second batch, and 300 kilogram in our third batch. So total we have 600 kilograms, 600,000 kilograms. So 58 million divided by 600,000 kilograms. Each kilogram cost is 96.67. So each kilogram cost us 96.67 dirham. So cost of goods sold would be, we sold 520,000 multiplied by 96.67. This gives us 50.267 million. So 50.267 million is your cost of goods sold. Gross profit would be 124.8 minus 50.267. This equals to 74.533 million dirham. Ending inventory would be, now out of total 600,000 kilogram, how much we have sold? 520. So we are left with 80,000, and each kilogram is worth 96.67. So 96.67 multiplied by 80,000 would be 7.733 million. So this is our ending inventory. So total we have 600,000. We sold 520. We are left with how much? 80,000 kilogram. It's the same question, but now we need to use FIFO, first in, first out. So 100,000 kilogram came first at the rate of 110. Then we bought 200,000 kilogram at the rate of 100, and then we bought 300,000 worth of soap at 90. Now we sold 100,000 from the first batch, 180, and then 240. So total amount we sold was 520,000. So if it is first in, first out, sales would remain the same. That is 520 multiplied by 240. So it will remain the same again. That is 124.8 million. Now cost of goods sold, out of this 520, if it is first in, first out, the first one that we're going to go is 100,000, then 200,000. Then how much we are left with? We have already sold 300,000. Out of 520, if you have sold 300,000, how much left? 220. So 220,000 will go from this place. So total cost of goods sold would be 100,000 multiplied by 1110 plus 200,000 multiplied by 100, and then 220,000 multiplied by 90. That will going to give us 50.8 million. That is our cost of goods sold. First in, first out. So first in, this came first, it will be sold first. Our gross profit would be 124.8 minus 50.8, that is 74 million. And our ending inventory. So out of 300,000, we are left with 80,000. We have already sold 100,000, 200,000 and 220,000 from 300,000. So 80,000 is left. So our ending inventory would be 80,000 multiplied by 90. That is 7.2 million there. Fourth part consists of the same question, but now we need to use last in, first out. So we bought 100,000 for 110, 200,000 for 100, 300,000 for 90, and we sold 520 worth of goods. Sales would again remain the same, 520 multiplied by 240, because we are selling it at the rate of 240. This would again be 124.8 million. Now if we are selling 520 and if it is last in, first out, first we will going to sell all of this, then we will going to sell the second batch, and then we will going to sell 20,000 from our first batch, because last in, first out. So last in, this came last and this will be sold first. So 20,000 is left. So 300 plus 200, 500,000, and we have sold 520. So we will going to subtract 20,000 from our first batch. So our total cost of goods sold would be 300,000 multiplied by 90 plus 200,000 multiplied by 100 plus 20,000 multiplied by 110. So total cost of goods sold would be 49.2 million. So 300,000 went first, then 200,000, and then 20,000 from the first batch. 49.2 million is cost of goods sold. Gross profit would be 124.8 minus 49.2, that is 75.6 million. Ending in inventory, quite simple. Out of this 100,000, 20,000 has been sold and we are left with 80,000. So ending inventory would be 80,000 multiplied by 110, that is equivalent to 8.8 million dirham. So this is a summary of what we have done. So cost of sales, ending inventory, total cost of goods available for sale, that remains same throughout, and we are also given gross profit. So this is the summary. How do we come up with total cost of goods available for sale? 100,000 multiplied by 100, 110, because the first batch is for 110. 200,000 multiplied by 100, and 300,000 multiplied by 90. So if we add them all up, so 100,000 multiplied by 110, we have 11 million. 200,000 multiplied by 100, we have 20 million. 300,000 multiplied by 90, we have 27 million. If we add all of them up, we have 58 million. First of all, we need to understand specific identification and FIFO, first in, first out, does not change. They don't change the gross profit, ending inventory, cost of goods sold. Nothing will change if you go from perpetual to periodic or periodic to perpetual. Cost of goods sold, gross profit, ending inventory will not change. But in last in, first out, and weighted average, if you go from perpetual to periodic and periodic to perpetual, then cost of goods sold, ending inventory, gross profit, everything would going to change. We have the same question that we did previously, but now they have actually divided our sales into different point in time. Now, the company example 2 had used a perpetual inventory system. The timing of purchase and sales would affect the amount of cost of sales and inventory. Below is a record of the purchase, sales, and quantity of inventory on hand after the transaction. So, if you remember, we sold total amount of what we sold was 520,000 worth kilogram worth of soap. So if you add 80, 100, 60, 40, 70, 90, 80, this will be 520. 100 plus 60 plus 40 is 200. 70 plus 90 plus 80 is 240. And 80. So 80 plus 200 plus 240 equals to 520. And these are the time frame in which the sales has been made. Now, as we know, if we are using first in, first out, either you use perpetual or periodic, cost of sale, ending inventory, gross profit will not change. But if you are using last in, first out, then things would change. Now, let's find out first of all sales. Sales remain same. Sales doesn't change. Sales 520 multiplied by 240. This remains same. That was 124.8 million. Cost of goods sold will change. Now last in, first out. We are using last in, first out because this will going to change. So out of 520 now we know when the sales are taking place. So last in, first out. These are the sales that have been made. So last in, first out. So this came last. So we need to sell them 80. We need to sell 80,000, 90, and 70. So out of 300, we need to sell how much? 240. That is our first thing. So 240 into 90. How much? 60,000 is left. Now we are selling. So 60,000 is left. Perpetual versus periodic inventory systems. Now this is the same question, example 2 that we were doing, but now it is perpetual. Now first thing we need to understand in specific identification and in, first out, gross profit ending inventory cost of goods sold will not change if we use periodic or perpetual. Either we use periodic or either we use perpetual, ending inventory cost, gross profit, cost of goods sold will not change. Second thing, if we are using last in, first out or weighted average cost, ending inventory, gross profit, cost of goods sold, everything will change if we go from periodic to perpetual. Now over here we have been told that the sale that was made, so we sold total 520,000 worth of kilogram worth of soap. Now we know that 80,000 came on 1st February and so on and so forth. Now we know exactly the time, and we need to find out, has ending inventory, gross profit, cost of goods sold has changed if we had used last in, first out. We know that in first in, first out, ending inventory, gross profit, cost of goods sold will not change. So the first thing is sales. Sales will not change. So we sold 520,000 worth of goods multiplied by 240. So we get 124.8. Now the second thing we need to do is find out cost of goods sold. So as we move in perpetual, we start from here, and as we move we make decision what are we selling and what are we, when are we buying and what are we selling. So we make decision as we go through in time. So the first thing is that we had 100,000 and we sold 80,000. So cost of goods sold first would be 80,000 multiplied by 110. So out of 100,000, 80 is gone and we are left with 20,000. Now we bought 200,000 more, so we have 200,000 plus 20,000. Now we sold 100,000, 60,000, 40,000. Total sales that we made was of 200,000. So if it is last in, first out, 20,000 will remain, but instead we will use this 20,000 as cost of goods sold. So plus 200,000 multiplied by 100, because it is last in, first out. So we have 20,000, we bought 200,000 more, but we made a sale of 200,000. So which one will go first? This one will go first because it is last in, first out. So again we are left with 20,000 and you bought 300,000 more. And now how much we are selling? 70 plus 90 is 160. 160 plus 80 is 240. So out of this 300 we sell 240 plus 240,000 multiplied by 90. So our total cost of goods sold would be 50,400, and our gross profit would be 124.8 minus 50,400, that is 74.4 million. And lastly we need to find out ending inventory. We also need to find out ending inventory. Let's make our ending inventory portion over here. So we sold 240 out of this 300, so we are left with how much? 60. And we are also left with this 20 that we made. This 20 is coming from our first purchase. So 20 multiplied by 110 plus how much is left? 60 multiplied by 90. So our ending inventory would be 20,000 multiplied by 110 plus 60,000 multiplied by 90. So our total ending inventory is 7.6 million. As you recall, we started with 100,000, we sold 80, we were left with 20 because it is last in, first out. So out of this new purchase of 20,000, 200,000, this 200,000 will be sold first, and then we are again left with 20,000 and we bought 300,000 more and we made sale of 240,000. So out of this 300, 240 will go, we will be left with 60 and you will also be left with 20. Now as we have shown that our gross profit is 50.4, total sales remain same, our cost of sale is 50.4 and our gross profit 74.4 million. So our cost of goods sold was 50.4, gross profit was 74.4 million, ending inventory is 7.6 million. Now, this was from perpetual, and we also did periodic in our previous example. Now, let's do it periodic again. So, sales remain the same. So, out of 520,000 that we sold, if it is last in, first out, if it is last in, first out, so we made purchase of 100, 200, and 300. So, if you are selling 520, so first this 300 will go, then this 200 will go, and then 20,000 will go from 100,000. So cost of sale would be 300,000 multiplied by 90, 200,000 multiplied by 100, and 20,000 multiplied by 110. So we are left with cost of sale is 49.2 million. Our gross profit would be 224.8 minus 49.2 million, and our ending inventory would be, so out of this 100,000, 80,000 is left, multiplied by 110, this would be 8.8 million. So if you look closely, our numbers are changing. So our gross profit in perpetual is 74.4, but in periodic it is 75.6 million. Even ending inventory has changed. In perpetual it is 7.6 million, and in periodic it is 8.8 million dirham.